Chapter 1. The Statistics of Survival. Let's start with the most pervasive phrase in personal finance today: paycheck to paycheck. For decades, this was a term reserved for the working poor, those struggling at the very margins of the economy. But today, it is the standard American operating procedure. Recent data indicates that between 60% to 67% of the American population lives paycheck to paycheck. Let that sink in. 2 out of every 3 people you pass on the street have zero financial margin. If their paycheck is delayed by a week, the lights go out, or the rent is missed. And before you assume this is just an income problem, listen to this. According to reports from LendingClub and Bloomberg, over 30% of Americans earning 6 figures, more than $100,000 a year, are also living paycheck to paycheck. How did we get here? How did the wealthiest nation in the history of the world create a middle class that is financially anorexic? The answer lies in the debt mountain. The $17 trillion burden. As of late 2024 and moving into 2025, total U.S. household debt has shattered records, hovering around $17.8 trillion. But the number that should scare you isn't the mortgage debt, it's the revolving debt. Credit card debt in America has officially surpassed $1.14 trillion. Pause for effect. Think about the mechanics of that. We aren't just borrowing money to buy homes, assets that generally appreciate. We are borrowing over $1 trillion to buy groceries, gas, clothes, and dinners. We are financing our survival at an average interest rate of over 22%. The average American household carries a credit card balance of approximately $6,000 to $7,000. At a 22% interest rate, if you only make the minimum payment, you will be paying for that dinner you ate last Tuesday for the next 15 years. You will pay for it 3 times over. This is not just bad math. This is a systemic trap. The savings crisis. While debt is skyrocketing, the safety net is vanishing. The Federal Reserve conducts an annual survey on the economic well-being of U.S. households. For years, they have asked a simple question: could you cover a $400 emergency expense using cash or a savings equivalent? Consistently, nearly 40% of Americans say no. A blown tire, a root canal, a broken water heater. These are not catastrophes. These are the inconveniences of life. Yet, for nearly half the country, a $400 inconvenience is a financial disaster that forces them back to the credit card, deepening the cycle. Let's look at retirement. The median retirement savings for all American families is roughly $87,000. Not $800,000. $87,000. If you retire at 65 and live to 85, that $87,000 breaks down to about $4,300 a year. That is $350 a month. That doesn't even cover groceries, let alone housing or healthcare. The reality is, the average American is on a collision course with a retirement crisis of epic proportions. Sound effects. Deep, resonant transition sound. Chapter 2. The Anatomy of the Trap, Housing and Inflation. We have established the what. Now we must understand the why. Why is the average American drowning? Is it just too many lattes and avocados? Or is the system fundamentally shifting under our feet? The answer is a combination of behavior and brutal structural economics. Let's talk about the biggest line item in your budget: housing. The death of the starter home. In the 1970s and 80s, the ratio of median home price to median household income was about 3 to 1. If you made $30,000, a house cost $90,000. It was a stretch, but it was math that worked. Today, that ratio has exploded. In many markets, the median home price is 5 to 7 times the median income. We have seen a 47% increase in home prices since early 2020. Meanwhile, wages, while they have risen, have not kept pace with asset inflation. This has created a generation of permanent renters. But renting is no longer the affordable alternative. The rule of thumb used to be that you shouldn't spend more than 30% of your gross income on housing. Today, millions of Americans are rent-burdened, spending 40%, 50%, or even 60% of their income just to have a roof over their heads. When 50% of your money goes to rent and 15% goes to taxes, you are left with 35% to fund your life, your health, your transport, and your future. The math simply does not work. The car loan crisis. If housing is the primary fire, cars are the gasoline we pour on it. The average new car payment in America is now hovering over $730 a month. For used cars, it's over $530. We have normalized the idea that a car payment is a life tax, a bill you will pay forever, like electricity or water. But here is the statistic that is truly alarming: the rise of the 84-month loan. 7-year car loans are now common. But because the cars are so expensive that to get the monthly payment down to a manageable $700, dealers have to stretch the loan term out for nearly a decade. This creates negative equity. Millions of Americans are underwater on their cars, meaning they owe more on the car than the car is worth. They are driving a liability that is actively destroying their net worth every single mile. Inflation, the silent tax. We cannot discuss the financial state of the American without discussing inflation. While the headlines say inflation is cooling, that only means prices are rising slower than before. It does not mean prices are going down. The cumulative inflation of the last few years has permanently reset the price floor. The cost of groceries, insurance, and services has shifted upward by 20% to 30% in a very short window. This is what economists call the eroding purchasing power. If you didn't get a 25% raise in the last 3 years, you effectively took a pay cut. The average American is working harder, for more hours, to buy less than they could 5 years ago. Sound effects. Thoughtful, slightly more upbeat transition. Chapter 3. The psychology of spending. We have blamed the banks, the housing market, and inflation. But if we want to be honest, brutally honest, we have to look in the mirror. The financial crisis of the average American is not just mathematical, it is psychological. We live in an instant gratification economy. The comparison trap. 100 years ago, you only compared yourself to your neighbors. If they got a new truck, maybe you felt a pang of jealousy. Today, you are comparing yourself to the top 1% of the world, 24 hours a day, 7 days a week. Social media has weaponized envy. We see the vacations, the outfits, the dinners, and we feel a subconscious pressure to participate. We spend money we don't have, to impress people we don't know, to fill a void that consumption cannot fill. This is known as lifestyle creep. As soon as we get a raise, we don't save the difference. We upgrade our lifestyle. We move to a slightly better apartment. We lease a slightly nicer car. We switch from generic to brand name. We run on a hedonic treadmill, always moving but never getting anywhere. The subscription drain. Look at your bank statement. The average American spends hundreds of dollars a month on subscriptions they barely use. Streaming services, gym memberships, digital apps, monthly boxes. It is the death by 1,000 cuts. $15 here, $12 there. It doesn't feel like a lot in the moment, but collectively, it is a hole in your financial boat. Corporations have shifted to subscription models because they know human psychology. We are lazy. We will forget to cancel. We will accept the $10 charge rather than go through the hassle of clicking unsubscribe. We have become passive participants in our own financial destruction. Chapter 4. The Solution Framework. The Road Out. Enough of the bad news. If you are listening to this, you don't just want to know how bad it is. You want to know how to get out. The situation is alarming, but it is not hopeless. The math that works against you can be turned to work for you, but it requires a radical shift in mindset. Here is the strategic blueprint to escaping the average American financial trap. Step 1. The audit, face the dragon. You cannot fix what you do not measure. Most people avoid looking at their bank accounts because it causes anxiety. You must push through that. Sit down. Print out the last 3 months of your bank statements. Highlight every single expense. Categorize them, needs versus wants. You will be shocked. You will find that you spent $400 on takeout coffee and Uber Eats. You will find subscriptions you forgot about. This is your bleeding report. You have to stop the bleeding. Step 2. The emergency buffer. Before you pay off debt, you need a shield. You need $1,000 to $2,000 in a separate savings account. This is not for a vacation. This is for when the car breaks down, so you don't have to use the credit card. This small buffer breaks the cycle of borrowing. Step 3. The debt avalanche versus the snowball. There are two ways to attack that $17 trillion debt mountain on a personal level. The avalanche: pay off the debt with the highest interest rate first. Mathematically, this saves you the most money. The snowball: pay off the smallest balance first, regardless of the interest rate. Psychologically, for the average American, the snowball method often works better. Because you need a win. You need to see a debt disappear. Knocking out a $500 medical bill gives you the dopamine hit and the momentum to attack the $2,000 credit card bill next. Step 4. Attack the big three. You can cut coupons all day, but if you lose on the big three, housing, transportation, and food, you lose the war. Housing: if your rent is 50% of your income, you have to move or you have to get a roommate. There is no other math that fixes this. You cannot budget your way out of a housing cost that is too high. Transportation: get out of the car payment. If you have a $40,000 car and you make $50,000 a year, you are broke. Sell the car. Buy a cheap, reliable point-A to point-B vehicle. Drive it until the wheels fall off. The status of a new car is not worth your freedom. Food: meal prep. The average American spends an exorbitant amount on dining out. Cooking at home is the single highest ROI, return on investment, activity you can do for your wallet and your health. Step 5. Increase the shovel. There is a limit to how much you can cut expenses. There is no limit to how much you can earn. In this gig economy, the average American has access to income streams that didn't exist 20 years ago. Freelancing, consulting, driving, selling digital products. You don't need a side hustle forever, but you might need one for 24 months to clear the debris of your debt. Sound effects: uplifting, building music. Conclusion of Part 1. The statistics are against you. The marketing algorithms are against you. The banking system is designed to keep you in debt. But you are not a statistic. You are an individual with agency. The American dream is not dead, but it has changed. It is no longer about buying things. It is about buying your freedom. It starts with saying no. No to the new car. No to the credit card swipe. No to the expectation that you must look rich to be happy. When you stop trying to look like the average American, you can finally start building wealth like the exceptional few. In the next part of this series, we will go deeper into the mechanics of investing, how to take that money you've saved and make it grow so that one day your money works harder than you do.